Good morning. My name is Brant Steck, I'm Vice President of BUI, and on behalf of the entire BUI team, welcome. You are here for Seeking Shelter Amidst an Imminent Tax Storm with Brian Seigel, a presentation that was created to provide you with an up-to-the-minute legislative update and to provide you with planning ideas to help you better serve your clients. Before introducing our speaker, I want to hit a couple of quick housekeeping items. Number one, this meeting is approved for 1 hour of continuing education credit for CFPs anywhere in the country for Missouri life and health agents and Missouri MCLEs. So if you're a CFP anywhere, if you're a Missouri life and health agent or a Missouri attorney, as soon as I'm done with my comments, I'm going to post a link in the chat feature of this meeting. If you're not familiar with where that is, you just hover your cursor over the bottom of the screen. Just click on that link, enter in your credentials, and we'll file for your CE. Please make sure that you put the correct ID number. Without that ID number, we cannot file for your CE. Also, in that chat feature, if you have questions throughout the meeting, please send those questions directly to me. By default, the chat meeting goes to everyone. So on that drop down, just select my name, Brant Steck, send those questions to me. I will aggregate and consolidate them as much as I can to make best use of our Q&A session. Now, a special unique offering for this meeting, Brian is making himself available to any advisor who attends this meeting to do a client version of this presentation. So if you can get at least 5 of your high net worth clients into a meeting, Brian will present this information directly to your clients, a unique offering just for the advisors in this meeting. If you want to take part in that, please reach out to any of your friends at BUI and we will help coordinate things with Brian. Now, on to our speaker. Our speaker today is Mr. Brian Seigel, BUI's Director of Advanced Planning. Though not practicing law at BUI, Brian is a licensed attorney in Missouri and Illinois. He was a private practice estate and business planning attorney prior to joining BUI about 13 years ago. Brian is an accredited estate planner. He is a member of the Missouri Bar Probate and Trust Committee, the Missouri Bar Elder Law Committee, and the Missouri Bar Taxation Committee. In his role at BUI, Brian partners with financial service professionals like you to work directly with your clients in their estate and business planning needs. He's even created several processes that make it really easy for you to engage him and to get the information to him that he needs to do an analysis. And he even joins you in the client meeting. And because of your relationship with BUI, there's no cost in doing so. So everybody in this meeting has an attorney on their team through your relationship with BUI. With that said, without further ado, my friend and colleague, Mr. Brian Seigel.
Thank you, Brant, and good morning, everyone. Brant talked about what amounts to 25 years in the estate planning world, and I can honestly say that this is the most unique time I have ever seen in my 25 years in estate planning. And that's primarily because not only are we seeing tax change, which proposed tax change is normal. That's something that happens all the time, and we'll get into exactly why. But in addition, the present proposals also seek to chill existing planning and planning that's available today that will not likely be available going forward. So, it's a lot of strategies that we have available to us now that we're probably not going to have available going forward. And, I go back to talking about the change and how it's something that just naturally happens in the tax world. When I first started practicing law in 1996, the federal estate tax exemption at that time was $600,000 per person. And an estate tax rate that graduated from 37% up to 55%. Well, at that time, if you had a client who owned a house and a vehicle and had a bank account, modest investments, owned a life insurance policy, their estate was going to be subject to estate tax. Fast forward to now, we've got the highest estate tax exemptions we've ever had, 11.7 million. And there are very few people who are actually subject to the estate tax today. Married couple, 23.4 million is a whole lot more than back in 1996, 1.2 million. And so as a result, you can look at this Yahoo Finance chart. Over the last 20 years, based on changes in the law, there's been a steady decline in the number of estates that have actually paid estate tax. And other than 2010, when the estate tax was actually repealed for 1 year, in 2018 to 2020, it's been our shortest period for basically very little estate tax being paid. I say very little estate tax. It's actually fewer estates owing taxes, but those estates are growing. So still, it's not that the revenue that's generated by the estate tax has changed all that much. It's just more being paid by fewer estates. But looking at the history of the federal estate tax, it has truly been a moving target. Used to be that in the 1700s and 1800s, the estate tax was enacted during times of war to help fund the war. But in 1916 is really when we had the first permanent estate tax legislation. I say permanent, that's when the estate tax really became a permanent part of the estate tax, of the tax code in general. And you can see here that we've had all kinds of changes throughout time, and they're not even all listed on here. There were lots of changes that occurred during these various periods. But again, that's pretty natural for the tax law to change over time. And it's specifically as it relates to the federal estate tax. I think this chart says a lot. This is the last 105 years, again, since the federal estate tax has been a permanent part of the tax code. And the estate tax exemption, inflation adjusted over time, you can see that on the far right-hand side, the exemption has never been higher than it is today. The other interesting thing about this chart is you see no horizontal lines. There's no period where the estate tax exemption has stayed stagnant. It's forever been changing. And the reason for that change, and I'm not expressing any political opinion here, but it's instead just based on reality. The reality is that it depends on which party is in control of the government. During times when the Republicans are in control of Congress and the presidency, we see higher estate tax exemptions, we see lower estate tax rates. When Democrats are in control, we see just the opposite. And I go back to the conversations that I was having with advisors and their high net worth clients just 4 years ago. And what I heard more often than not, was, okay, well, yeah, I may have a $15 million estate, but I think Trump is going to repeal the estate tax. Well, and he was not able to repeal the estate tax, but as I mentioned, we did get the highest estate tax exemptions that we've had in the history of the tax. But now the conversation is very different, and people tend to fall into one of two camps now. Now, with the Democrats in control, it's, oh my God, I'm going to get taxed. My taxes are going to go up. And I don't want my family to suffer, so I need to do planning. And they're ready to just plan away, and there's almost this panic, and they want to put something in place immediately. And by the way, that's not wrong for them to want to do. Planning is not a bad thing. But on the other side, people say, you know what, I just want to wait and see what the tax law is ultimately going to be. Yet, again, the tax law is always going to change, and clients, when they don't plan, are really putting themselves in a position where they're not maximizing opportunities, number one, to plan, and number two, they are probably missing out on opportunities to remove assets from the estate or to otherwise minimize that potential estate taxation. So looking at it today, right now, as I mentioned, we have an $11.7 million estate tax exemption. It's actually an $11.7 million estate and gift tax exemption. It's one and the same. It's unified. So the significance of that is the government doesn't care right now if you give it away during life or a death. 11.7 million is the number. And as an example, if a client were to give away $5 million in 2021, technically they have 6.7 million left on their exemption to give away during lifetime or at death, assuming that we still have an $11.7 million state tax exemption, which we'll talk about more. They won't. Part two is having these $15,000 annual exclusion gifts. And annual exclusion gifts, that's the amount that can be given away to as many individuals as your client would want to give away in a given year, and there's no gift tax consequence. So for a married couple, they can actually double that. They can actually give away $30,000. And that's a number that is indexed for inflation, rounded up to the nearest $1,000. So I would actually expect for that 15,000 to increase to 16,000 next year. We all saw what happened with the inflation numbers for Social Security. I think we can certainly see a lot of the inflation adjusted numbers for the government going up when they're announced in the next couple of weeks. We also have what I consider to be one of the most underutilized gifting exemptions, actually two of the most underutilized gifting exemptions, the unlimited medical exemption, and then also the unlimited tuition exemption. I'm going to talk about those in more detail a little bit later. And we also have portability available right now, which is when one spouse passes away, the surviving spouse can take the deceased spouse's unused estate tax exemption and add it to their own. So how did we get here with these high estate tax exemptions? Again, the highest that we've ever had. And that is from the 2017 Tax Cuts and Jobs Act. And that was passed at a time when we had a Republican-controlled Congress and a Republican president. And so they were able to pass the law, but what is commonly misunderstood about the Tax Cuts and Jobs Act is that it was passed as part of the reconciliation process, which I'm going to talk about in more detail later. But that is significant because through the reconciliation process, you can't have a permanent law, meaning that the Tax Cuts and Jobs Act is temporary. At least provisions of it are temporary, specifically as it relates to the federal estate tax. These high exemptions that we have right now, it's actually 10 million indexed for inflation. So that's how we got to the 11.7 million. These high exemptions are scheduled to be cut in half January 1st, 2026, as it stands now. So I hear this all the time. And even in a conversation yesterday with an attorney who said, yeah, I'm in agreement with you. I tend to think that we're probably going to see a lower estate tax exemption. No, we are going to see a lower estate tax exemption. Doesn't matter if it happens January 1st, 2026, or if it happens effective this year, the estate tax exemption is going to go down. Again, it's all part of the change that we see and part of that political cycle. So bottom line, if you have a client who expects to live past 2025, which we certainly hope that most of your clients do, if they have an estate of at least $5 million and they want to protect their assets from potential taxation, the time to plan is now. And when I say plan, it doesn't necessarily mean using all kinds of advanced strategies. If you've got someone who's got a net worth of $5 million, they may have to do very little to address the estate tax, but they probably have to do something. And so planning is the key, and making sure that they're moving forward with some sort of plan that's going to help achieve their objectives. So, all right, you look at what the current political environment provides for them. Yes, we have a Democratic controlled Senate, but it's controlled by a 50-50 vote between the Democrats and Republicans, and the tie-breaking vote being cast by the vice president. That's what gives the Democratic the majority in the Senate. And that's significant because it means that the Democrats don't have any margin for error here. We have two senators right now, Senator Manchin and Senator Sinema, who both have not necessarily been on board with what's been proposed as far as the infrastructure bill goes. I'm going to talk about all that in depth, but the bottom line here is, again, that the Democrats can't lose even one vote. They can't even have one dissenter. They've got to have everyone on board to be able to pass legislation. They also have a majority in the House, although it's a slim majority. They, of course, have a Democratic president. Couple that with the fact that there's been significant spending on the COVID stimulus. On top of that, we do have an infrastructure proposal at this point. The president's proposal was a $3.5 trillion plan, and there has to be a way to pay for that. And actually, the president has said, this is a zero cost plan. What does he mean by that? He's going to raise taxes enough to completely pay for that spending. And so that's led to legislation that we've had. And the question is, well, all right, so you take into account the fact that they're trying to put this infrastructure plan in place. The Democrats are technically in full control. Is this the perfect storm as it relates to tax planning and specifically estate planning? And the answer is maybe. But again, what happens with a storm? It eventually passes. And as it passes, a new regime comes in and things change. So I think more than anything, we can just expect change going forward. But what I'd like to do is I'd like to walk through what proposals are currently out there, starting with the president's plan. And I don't think you can actually dismiss anything at this point. I think until we actually see legislation, until it's actually enacted, anything is potentially at risk here, or could be on the chopping block as far as existing strategies go. So I want to talk about everything that's pending and what the chances of various items are to actually make it into any final legislation if we see final legislation. That's another possibility here, is with the Democrats not having any margin for error, we may not even see any change to the tax law. That's always a possibility. But again, I always caution, we're going to have change no matter what as it relates to the estate tax exemption, because if it doesn't happen now, it's going to happen 1/1/26. All right, so let's first talk about the income taxes, and specifically ordinary income tax rates. And what the president has proposed and what he campaigned on was a max tax bracket of 39.6%. And this would only be for people, earners of at least $400,000 annually. He specifically said that he wasn't going to change the increased taxes for those earning less than $400,000. And what I've heard from some planners is, well, okay, our top rate right now is 37%. It's going up to 39.6%. That's not that big of a deal. Well, it actually sort of is more than that 2.6%. If you look at the left-hand side for a married couple filing jointly, right now, $400,000 is hitting the top of that 40% of that 32% bracket. So someone earning 400,000 is at 32%, graduating to 35%. Well, the 39.6% rate would take over the top part of that 32% bracket, the entire 35% bracket, and then obviously 37% and above. So, actually it's more like a 4.6% increase, if not more. If you look at the right-hand side, it's a similar story. That is, the 35% bracket actually is probably about 40% of the way in at $400,000 of income. It would increase from that point from 35 to 39.6%. It's a more significant increase. And for high net worth clients, high earners, they are looking at significantly more income tax if these income tax changes actually come to fruition. In addition to ordinary income tax rates, the president also has talked about capital gains rates. Now, this is from his proposal during the campaign trail. And right now, we have a max capital gains rate of 20% with a 3.8% surtax on net investment income for a total rate of 23.8%. What the president was proposing was for those earning at least $1 million, jumping to the highest ordinary income tax bracket, which again would be 39.6% under his plan. Add to that the 3.8% net investment income surtax, and you're at 43.4%, almost double what the current rate is. Now, the good news is that this is not actually part of what's been proposed in actual legislation. So again, I mention it, but only because we don't know what's going to be in any final legislation if we actually see something pass. Also related to the capital gains rates is President Biden's comment that he made during the campaign trail in June of last year. I'm going to get rid of the bulk of Trump's $2 trillion tax cut, and a lot of you may not like that, but I'm going to close loopholes like capital gains and stepped up basis. So step up in basis is one of the, to me, greatest benefits that we have on the tax side at death. That is, if you have a client who buys a share of stock for $10, waits a year and then sells it, well, they have to pay capital gains tax on that $90 gain. If instead that same client bought that share of stock for $10 and then after a year passed away when it was worth $100, then there's a basis step up for the heirs. That is, the basis steps up to whatever the date of death value is. Here, $100. So if the heirs turn around and sell it the next day, there's no capital gains tax that has to be paid. So that's, again, one of the greatest benefits that we have right now in the tax law at death. Well, so President Biden was proposing to remove that benefit. And again, I'm going to talk a little bit more later about how that sort of has evolved from his original proposal. But in addition, President Biden addressed the estate and gift tax exemption sort of in a generic way when he was campaigning by saying that he wanted them to return to historical norms. What is historical norms? Well, most people felt like it was one of two things. President Obama, in every one of his Green Book budget proposals, proposed a $3.5 million federal estate tax exemption. So could have meant $3.5 million. Or alternatively, knowing that we were headed to a $5 million estate tax exemption index for inflation, January 1st, 2026, it may have just been an acceleration of a return to that $5 million exemption. In addition, we don't know exactly what historical norms meant for gift tax exemptions, but it used to be that when there was a $3.5 million estate tax exemption in place, there was a $1 million gifting exemption in place. So the estate and gift tax exemption were not unified. So does it mean a return to a $1 million gifting exemption? We don't know the answer to that. And then the timing here, well, would any change in the exemptions and change in the law be effective next year? Would it be effective upon enactment of the bill when the president signs it? Would it be retroactive to January 1st of this year? Again, there is no indication of any of that. Well, so if we fast forward to January of this year, when actually March is when the first legislation was proposed. But once the Democrats took control of Congress, once the president was sworn in March, we saw Bernie Sanders as the primary sponsor of the 99.5% Act. And this bill actually would have addressed lots of areas, but I've just sort of narrowed it down to the estate tax and specifically the estate planning area and the most specific proposals there. And this legislation would have reduced the estate tax exemption to $3.5 million. In addition, the estate tax rate would have changed from 40% to 45%, and it would have graduated all the way up to 65% for billionaires. With the generation skipping transfer tax, right now, clients have the ability to use generation skipping transfer tax exemption. They can transfer money into a trust. And if they live in a jurisdiction where perpetual trusts are allowed, then technically they could gift money into this trust and it will never again be subject to any type of transfer tax, estate or gift taxes. Well, what this bill would have done is say that no trust can be in existence for more than 50 years. So technically taxes would have to be paid then once they become part of someone's estate and they pass away. And so again, the government making sure that they can take their slice of the pie at least every 50 years. Also significant was in this bill, no more valuation discounts for a passive entity. So things like family limited partnerships, family limited liability companies could no longer take valuation discounts, taking away a huge planning vehicle that is utilized today. In addition, the proposed legislation would have eliminated Grantor Trusts and Grantor Trust status. Now, what is that? Well, Grantor Trust status is with an irrevocable trust. When the trust is irrevocable, it's going to keep the assets out of the estate for estate tax purposes. But there are certain powers that can be included within the trust that actually make the trust defective. And it's a horrible name, I know, but that's what you get when you have attorneys naming trusts and specific strategies. But it's an intentionally defective grantor trust. And what you do is include a power that makes the trust defective for income tax purposes. That is, the grantor is the owner of the trust just for income tax purposes. And what this allows is for the grantor to be able to enter into transactions with the trust on a completely income tax-free basis. They could sell highly appreciated assets to the trust and don't have to recognize any capital gains because it's as if they're selling it to themselves. They can make loans to the trust, take back a promissory note, and again, it's a non-taxable transaction. But the goal with the strategy is to either get money inside of a trust to be able to either fund life insurance premiums or to just grow outside of the taxable estate. So have that growth occur in the trust out of the estate, keep a promissory note in the estate that's not growing in value. And what this proposed law would do is eliminate grantor trusts. And there are other forms of grantor trust that are used today as common estate planning techniques, like grantor retained annuity trust, qualified personal residence trust. A lot of the planning techniques that we use today, unfortunately, would not be available if this law had passed. Now, I say if this law had passed, and that's significant because what happened was this was proposed, but there seemed to be a lot of dissension within the Democratic Party. There were at least 13 or 14 representatives, Democratic representatives, who were concerned because they have elections coming up, either midterms or in the next presidential cycle. And their feeling was, okay, I'm going to hurt my reelection chances here if I actually vote across the board for tax increases. So instead, they looked at it and said, well, wait a second. The estate tax exemption is something that's coming down anyway. So we don't even have to vote for the exemption to be decreased at some point in the immediate future because it's going to happen in 4 to 5 years anyway, January 1st, 2026. And so at that point, that's when things pivoted and we had a new bill that was proposed. It is the Sensible Taxation and Equity Promotion Act, the STEP Act. And the primary sponsor was Senator Von Hollen from Maryland. And what this bill would do is end stepped up basis at death. So there would be no more stepped up basis up to a certain point. That is up to $1 million. There would be an exclusion, but anything over $1 million in gains would be subject to tax. And it would actually be taxed. Those gains would actually be taxed at death. So $1 million exclusion plus a $500,000 exclusion for a personal residence. But think about your business owner clients. Think about your farmer clients. Think about your clients who just have highly appreciated investments and look at having to potentially incur all of the tax due at death. And that would be a significant hit. Now, the biggest complaint against the STEP Act and against eliminating stepped up basis came from family-owned farms and family-owned businesses. Because the feeling was, wait a second, if you're going to only provide $1 million exclusion and the family actually has to pay this tax right away after the primary owner of the business or farm has passed away, then they're going to have to liquidate the primary asset. And it's no longer going to be a family-owned entity. So what the STEP Act included was allowing payments by installments over a 15-year period for farms and businesses. But that was viewed as something that wasn't enough. Still, the farming industry and various business outlets, trade associations were arguing vehemently against this. And so the president was negotiating it and actually reached the point where he said, okay, we're not actually going to make these families who inherit pay the tax upon the death of the primary owner. Instead, the tax wouldn't have to be paid until the farm or business was no longer owned by the family. Well, that still wasn't enough. The president still didn't have the support to pass legislation along those lines. That's when things pivoted yet again. And September 13th, we had the House Ways and Means Committee propose language for the Build Back Better Act, an 880-page bill with lots of just significant changes across the board in the estate planning world. And I'm going to hit on the highlights of them. So first, on the income tax side, this bill would increase the highest rate to 39.6% for single filers earning at least $400,000 and married filing jointly $450,000. So exactly in line with what the president was campaigning on. In addition, the corporate tax rate would increase to 26.5% on income in excess of $5 million. This is something that was actually expected to be a higher tax rate and hit at a lower level than 5 million. So some view that as a win. And in addition, there would be a 3% tax surcharge on modified adjusted gross income in excess of $5 million. So high income earners, in addition to having a 39.6% rate, would now have a 3% tax surcharge on top of it. Trusts would even have a bigger tax liability. Now, many of you may know that a trust right now, when it is its own tax-paying entity, is going to hit the highest tax bracket at roughly $13,000 of income. Well, in addition, what the Build Back Better Act would do, it would add this 3% surcharge on income at the $100,000 level. So significantly increasing that tax level again, and the tax that would be due for trusts. In addition, there were significant changes as it relates, and again, I say they're included in this bill, there were significant changes as it relates to retirement planning. So first and foremost is this legislation would prohibit IRA contributions when an account, an IRA, already had in excess of $10 million. But there's a caveat to that. It's with income thresholds. That is, if the IRA owner earns more than $400,000 as an individual, or $450,000 for a married couple. Additionally, there would be accelerated required minimum distributions. If an IRA has a balance in excess of $10 million, it would actually be 50% of the excess over 10 million that would have to be distributed out if, again, the account owner earns at least $400,000 as an individual or $450,000 as a married couple. So, and by the way, there's also one additional requirement that I didn't mention here in the slide, but that is if there's an IRA balance in excess of $20 million, then the full balance in excess of 20 million would have to be distributed out to the account owner with those same income thresholds, 400,000, 450. Now, I've talked to multiple CPAs about this, and everyone seems to be feeling the same way, that it's kind of silly the way that they drafted this, because yeah, an IRA can certainly grow to more than $10 million or more than $20 million, and you don't want to in any way curb that growth. But what the CPAs can control is limiting the income and keeping the income below $400,000 or $450,000 in many circumstances. So interesting that we just had this proposal, and immediately the CPAs and other smart minds are thinking of ways around what's been proposed. And certainly there will be lots of ways around any kind of provisions built into any final legislation. But in addition to the retirement planning changes, we had in this bill proposed capital gains tax rate, increasing the highest rate from 20% to 25%. And on the estate and gift tax side, the federal estate tax exemption, the reduction to a $5 million exemption indexed for inflation, would be accelerated from the January 1st, 2026 date to January 1st, 2022. In addition, much like for the 99.5% Act, there would be no valuation discounts for transfer of non-business assets. That's something that wouldn't take effect January 1st, 2022. That would actually take effect upon enactment of the bill, as soon as the president signs it. So again, that chill on planning that the government doesn't want for high net worth people to be able to take advantage of anymore. I'd say the most significant change proposed by the Build Back Better Act is the way that it treats grantor trusts. And same thing that I mentioned before, it would actually eliminate the benefits of grantor trusts and pull back into the estate the assets in a trust if the grantor is the owner for income tax purposes on a prospective basis. That is, after the date of enactment, this would apply to any trust created after that date. Now, it would grandfather trusts that were created pre-enactment, but there's one caveat to that, and that is it would grandfather the trusts to the extent that they are funded prior to the date of enactment. To the extent that gifts are made to the trust post-enactment, it would actually include a proportional amount of the trust assets in the estate for estate tax purposes. So as an example, if your client has an existing life insurance trust, all right, and it owns a $1 million life insurance policy, and there's an annual premium of $10,000 per year, the client has paid that premium for 9 years, has paid $90,000, and then this law is enacted, and the client makes a gift to the trust to pay that last premium, another $10,000, and then passes away. Well, 900,000 of that million would be outside of the taxable estate and would be free of estate taxes. The proportional amount, 10%, $100,000, would be included in the estate. Now, that is a really far-reaching provision. And I want to point out a couple of things about this. Number one is the infrastructure package originally, as proposed by President Biden, was $3.5 trillion. And that's what the Build Back Better Act is really based on in terms of generating revenue, raising taxes to provide for payment of that $3.5 trillion. Now, based on information that came out last week, that number is not looking like it's going to be 3.5 trillion. The numbers that they were discussing last week were between 1.9 trillion and 2.3 trillion. So significantly reducing the benefits that would be paid out through this legislation. And so additionally, the tax raising revenue in the bill also is significantly likely to be cut down. I don't know if it'll be exactly in half, but in that general ballpark. So the common thought is that a lot of these really far-reaching provisions that are built into this legislation, if it were to pass, which it's not going to pass in its present form, but if it did, a lot of these really far-reaching provisions would not be included. That's part one. Part two is we've even had Senator Manchin, who came out as recently as this week, saying that he would agree to something less than half of what was originally proposed by the president. So here, the number last week that was being floated was ballpark $2 trillion. And now Senator Manchin is still grasping and holding on to that less than half, less than 1.75 trillion. So the more that this gets cut down, the more that these increased tax provisions are going to be pulled out of the legislation. The other part is that the insurance lobby, you can be sure, is lobbying very hard against including this last provision of how this provision would affect existing trusts and grandfathered grantor trusts. We generally don't see when something is grandfathered, only grandfathering part of a strategy. It's either grandfathered or it's not. And the end likelihood is that if this even passes, that the grandfathering will fully be protecting existing trusts. Now, if for some reason it didn't, I would say that there are certainly still ways that money can be transferred into the trust and just not using gifting as a way of doing that. So inclusion would be part of the equation. And most likely it would be through split dollar loans split dollar would make a comeback like it's never made a comeback before. But there are, again, always ways around it. And that's just the immediate one that comes to mind. You can be sure that there are lots of smart estate planning minds out there who would be coming up with additional ways to be able to get money into a trust. All right, so the frequent question that I'm asked is, all right, well, so what's it going to take to get permanent legislation? And I always like to say, I always kind of laugh because, you know, tax legislation, we've talked about the change, it's only permanent until it does change. But, you know, what's really needed to make legislation permanent is a 60 vote threshold in the Senate. That's usually the holdup. And so think about that right now. We've got 50 Democrats, 50 Republicans. There's no 60 vote threshold that's going to make it with passage of legislation to increase taxes the way that has been proposed. That's where instead the Democrats are looking to use the reconciliation process. As I mentioned, the Republicans did the same exact thing 4 years ago. The reconciliation process was put in place to make it easier to pass legislation related to the budget because it's seen as something that's so important. You have to fund the government. And if there's a stalemate in Congress, that's at risk. And so really reconciliation does two things to make it easier to pass legislation related to the budget. One is only a simple majority is required in the Senate. So go back to our current composition in the Senate, 50 Democrats, 50 Republicans, and the vice president as the president of the Senate is the tie-breaking vote. So they've got their simple majority there. In addition, debate is limited. So you can't have any budget legislation that's going to stall due to the filibuster when you're using reconciliation. And at the same time, as I mentioned earlier, legislation cannot increase the deficit for more than 10 years. And so it has to sunset within that 10-year time frame. And it's all related. Now, the timing of all this, the frequent question that I've been asked since March is, okay, so when do you think we're going to see tax law change? And my date that I was throwing out was September 30th. Why? Because that's the end of the fiscal year for Congress. And technically, they're supposed to have a new budget in place by September 30th for the next fiscal year. Well, of course, they were unable to reach an agreement on the budget. And so what happened? We had an extension out to December 3rd. And so it's really interesting how it's all related with the debt ceiling too. You may recall the Republicans and specifically Mitch McConnell was saying, yeah, we're not going to help the Democrats increase the debt ceiling. That's something that they can do on their own and they need to do it. Well, what he was saying is they can do this on their own using reconciliation. But the Democrats weren't in a position where they could actually use reconciliation yet because they don't have the votes to be able to pass tax legislation. They don't have an agreement in place. And so that's where, again, it's sort of a political game here. And the Republicans, ultimately, enough of them did agree to raise the debt ceiling because no one wants to see us falter on our debts. And so now we're into December with that as well. And the Republicans, well knowing that the Democrats will indeed, in any final reconciliation legislation, address the debt ceiling as well. But again, it's all interrelated. All right, so I've talked a lot about the proposals that are out there and the sort of attack that is currently out there on current planning and planning that strategies that clients may not be able to take advantage of going forward. So what does that mean for your clients? Well, it means plan now. Don't wait. Clients need to make it in the door. Unfortunately, attorneys are so busy right now, they're not going to proactively reach out to clients to do planning. Valuation experts are so busy right now, it may be a challenge to get planning done that involves any kind of valuation discounts. But there are ways that you can help your clients by talking about strategies and ultimately driving them to the estate planning attorney's office. I'm going to focus on 3 of those areas today. One is existing trust reviews, and there I'm talking about revocable trust reviews. Second is going to be gifting. And then third is creating and funding grantor trusts, which, as I mentioned, they may be on the chopping block. But first, let's talk about revocable trusts. With revocable trust planning, the bottom line as it relates to taxes is flexibility is king. The more that things change, the more that we need to have flexibility built into documents. And I'm first going to talk about what already is the law, the Secure Act. The Secure Act came into existence last year. And you'll recall it happened at a time where a couple of months later, the conversation very quickly shifted away from the Secure Act and instead onto COVID and COVID stimulus. And what the Secure Act brought was significant changes in retirement planning and specifically distribution rules upon inheritance of an IRA. It used to be that beneficiaries of an IRA could take distributions over their life expectancy and so could also distribute the tax liability over their life expectancy as well. And what the Secure Act did was it consolidated that time frame to 10 years. And the Secure Act requires for full liquidation of an account under most circumstances for non-spouse beneficiaries. So it has to happen within 10 years. Well, the problem is a lot of revocable trusts are serving as beneficiaries of IRAs. And the provisions built into the revocable trust say that the trustee is required to take the minimum distributions out of the IRA and distribute the funds out to the trust beneficiaries. The problem is technically there is no required distribution until the end of the 10th year after the account owner has passed away, which means that all of the income tax due is going to be due at the end of that 10th year. So not only is it accelerated to 10 years as opposed to potentially lifetime, but it all has to be taken at one time, which is likely, depending on the IRA account value, gonna bump the beneficiaries into the highest income tax bracket as well. So instead, it's a very simple fix that could be built into a revocable trust, and that is giving the trustee the authority to take distributions in any way they see fit over the 10-year period. So it's something where trusts have to be reviewed to make sure that they're not going to force that distribution at the end of the 10th year. Second part of existing trust reviews relates to the estate tax provisions that traditionally were built into trusts with AB trust planning. And the concern here was always if one spouse passes away, well, we have something called the unlimited marital deduction, where that spouse can pass an unlimited amount to their surviving spouse, and there's no estate tax that has to be paid. The estate tax has to be paid when the second spouse passes away. Well, what would happen is one spouse passed away, left everything to the surviving spouse, and then the surviving spouse is sitting there with just their one estate tax exemption, owning all the assets. So they didn't use the deceased spouse's estate tax exemption at all. It was completely wasted. So AB trust planning was designed to fix that. Instead, you say, okay, if I die, then I leave whatever the estate tax exemption amount is to a trust, an irrevocable trust that's set up for the benefit of my spouse, but it's using my estate tax exemption to fund that trust. And then the remaining assets can pass to my surviving spouse outright or in a marital trust. And that was the way that the estate tax was dealt with to make sure that both exemptions were being used. Well, the problem with that is that when one spouse passes away, there's stepped up basis when those assets are included in their estate. But the assets don't get a second stepped up basis when the surviving spouse passes away. And so there could be 10, 15, 20 years that would pass before the surviving spouse passes, and you could be talking about significant tax liability. So that's when portability came along. Portability allows the surviving spouse to take the deceased spouse's estate tax exemption and add it to their own. And they would get a second stepped up basis at the surviving spouse's death. Well, so the lesson here is that you don't have to decide whether the tax planning provisions in the trusts are going to rule or whether portability is going to rule today. Instead, build flexibility into the document, allowing the surviving spouse to make that decision after the first spouse has passed away by including a disclaimer clause that says, okay, all the assets pass outright to the surviving spouse. but if the surviving spouse opts to disclaim them into the credit shelter trust and use the estate tax planning provisions of the credit shelter trust, then he or she can do that. Otherwise, they'll rely on portability, looking at income tax planning to be more important at that time. All right, so pivoting to gifting. Gifting is the best way to be able to minimize potential estate taxation. And that's because not only are you removing gifted principal from the estate, but you're also removing the future growth and appreciation on those funds, and in turn, minimizing estate tax exposure. So I want to talk about the exemptions that the government provides for. Estate tax planning always comes down to what the government allows. And the first one I mentioned before, annual exclusion gifts. Giving $15,000 to as many people as your client would want in a given year. If they've got 3 kids, giving $15,000 to each kid, $45,000 total. Gift splitting, again, each spouse giving that amount away, a total of $90,000. If a client is going to have an estate tax issue and doesn't gift in 2021, it's not as if they can carry that annual exclusion into the next year. They have lost the ability to gift for 2021 once they get to 2022 using annual exclusions. So you have to use it. And that's important because it's a lost opportunity when your client doesn't use the annual exclusion for the current year. Not only are they not removing principal, but they're not removing the future and growth and appreciation on that principal as well. Annual exclusions can be gifts outright to beneficiaries or can be in trust. Frequently, gifts are made to irrevocable trusts, which the trustee is going to use to leverage into a life insurance death benefit, a much larger liquid sum to provide, potentially make available sums, make sums available to pay the estate tax liability, but a great way to leverage up the gifting exclusions. And a frequent question I'm asked is, well, wait a second, so I can gift to a trust and I don't even have to tell my kids about it? No, you do. The government says that to make it a gift today, you have to give them notice. That's the crummy right or crummy withdrawal power, and give them the right to take the money today. They have that for a limited window of opportunity, usually up to 30 days. And if they don't take the money out within that 30 days, which they shouldn't, then the gift lapses and at that point becomes completed and the annual exclusion is used. In addition, we have unlimited gifting for 2 purposes. These are very similar. One is for medical expenses. The key here is that the gifts have to be made directly to the medical provider, can't be paid to the individual who is receiving the medical treatment. And pretty broad definition that's here on the screen: expenses incurred for diagnosis, cure, mitigation, treatment, or prevention of disease. And the other important thing is that it applies only to what's not going to be reimbursed by medical insurance. Similar is the unlimited tuition gifts, has to be paid directly to the education institution. It applies only to tuition, so none of the other ancillary expenses. But again, pretty broad definition of how it can be applied through whether it's college, whether it's private high school, lots of different ways to use it. And when clients have not set up 529 accounts or other college savings accounts for beneficiaries, then this could be a really great way to pay those tuition expenses in an unlimited amount. I mentioned 529s. With a college savings account, a client can actually pre-fund 5 years of gifting. That is, they're using the current year plus the next 4 years of annual exclusions. Currently, that's a total of $75,000 that can be gifted. And again, great opportunity to remove the principal plus the future growth and appreciation from the estate. The client just has to outlive that 5-year period. If they pass away halfway in, then half of the gift would be pulled back into the estate. Last one to mention, which I don't want to say least because it's probably the most important right now, is using lifetime exemption. We have an $11.7 million exemption right now, and it's likely that we're not going to potentially January 1st, 2022, certainly January 1st, 2026. So if your client, if for an ultra high net worth client who's worth say 80 million, 100 million, well, they should consider using their full $11.7 million exemption, because anything they get out that's more than 6 million or whatever we think the exemption is going to be later on is getting more out today than will be available later. And the government has already said there won't be any clawback. There's not a situation where your client gives away 11.7 million and then dies when the exemption is 6 million, and the government says, well, that additional 5.7 million we're not going to allow that. That's going to be pulled back into the estate. They've already said, no, when you give it, when the exemption is available at 11.7, the full amount is out of the taxable estate. Even for your high net worth clients who are not ultra high net worth, but they still have significant net worth, they have the ability to gift $1 million, $2 million. Any amount helps, because it's getting not only the principal out, but also the future growth and appreciation on those funds as well. All right, grantor trust planning. This is a window that is likely closing very soon. And there are two ways where a grantor trust can be used, and one is going to be difficult. That is a sale to an intentionally defective grantor trust, but the other is not. That is private financing. And this is where a client creates an intentionally defective grantor trust and loans money to the trust in exchange for a promissory note at the applicable federal rate as the interest rate. Right now, the long-term applicable federal rate for loans in excess of 9 years, 1.74%. Well, the trust does have to pay interest to the grantor at the applicable federal rate, but otherwise, you've got, if there's a $2 million loan that's made to the trust, the full $2 million is out of the estate and can be invested and can be utilized over time to pay a premium on a life insurance policy to leverage it up. Ultimately, when the client passes away, the life insurance death benefit pays out to the trust, and the trust pays off the loan, and the remaining balance of the life insurance proceeds will remain outside of the taxable estate. This is something that is available now. And we are working with a lot of advisors right now who have clients who are quickly putting these trusts in place and are funding them before any potential date of enactment for a new law to come into place that would not allow this planning any further. So it's a fantastic way to plan, but it has to be done ASAP. Sales to intentionally defective trusts work very similar. That is, an asset is sold in exchange for a promissory note. The problem here is one of valuation. Finding a valuation expert who has the time to be able to value a business in a short period of time may be difficult, but if you have a client who owns a farm or owns a business, it's at least worth discussing in the short term to see if it's something that can be put in place. At least having the trust put in place and the funding done for the trust. So I've thrown out a lot of information. I know I'm getting close on time here. And I think that, this can all be very overwhelming, and we just have to wait to see what ultimately is put in place. But you may be asking yourself at this point, what can BUI to help you to do with your most important clients as it relates to planning and dealing with the tax law changes? And I'm going to turn it back over to Brant to talk about that for just a couple of minutes.
Thanks, Brian. Excellent job. I've got a lot of questions, and I want to make sure that I get to all those questions, be respectful of everyone's participation here. Quickly, the number of CE sign-ins is nowhere close to the number of people in this meeting. I know there's a lot of CFPs, so please make sure you sign in and get your credit. My guess is that as a lot of you have been watching this presentation, you've been thinking, imagine what I could do with a resource like Brian on my team. This is a reminder that you do have a resource like Brian on your team through your partnership with BUI. As I mentioned at the forefront of the meeting, Brian is making himself available to do this presentation, a client version of this presentation, to your clients. If you wish for him to do so, reach out to me or anybody on the BUI marketing team, and we'll help coordinate. Also, on a more one-on-one basis, Brian has a process called estate evaluation, which is the review of high net worth clients' estate plans. It's as robust of a review as you're going to find anywhere. He literally reviews every provision of every document. He does an estate tax calculation. He lists out all the fiduciaries. He puts out flow charts on how assets distribute at death and disability. Many of you may be thinking, well, my clients that are high net worth, they have estate planning done. But the problem is that the clients view it as a box that's been checked. 5, 10, 15 years have gone by and they've never updated their plans. The reason is they know that if they walk into that attorney's office, they're going to be on the meter, and nobody likes to pay to go to see an attorney for a reason they don't understand. Brian's estate evaluation process is the why. client, why do you need to go back to the estate planning attorney? So it's a no cost option to the client because of your relationship. Brian will work directly with the clients. He'll present the report directly. And if anything needs to be updated with the estate plans, he'll even coordinate with the client's attorney of choice. So a very robust option and a way that Brian can get very involved in your planning. With that said, let's start getting into the questions, Brian. Brian, based upon your comments about Grantor Trust potentially not being available in the future, what advice would you give to someone currently gifting into a Grantor Trust already in existence to pay for life insurance premiums?
Yeah, it's an excellent question. And again, as I mentioned, I don't think this is going to be a part of any final legislation. Let's assume, though, that it is. Then we have to see whether there are ways to, number one, turn off Grantor Trust status, which based on the Build Back Better Act, you wouldn't want to do because it actually would cause inclusion. But again, that's not the law. So we have to see what final legislation provides for. Number two, I mentioned split dollar loans. I think that premiums will be paid through split dollar loans if that were the case. And there may be other ways to get funds in as well, but loaning money to a trust is probably the preferred way to deal with it if that were to come to fruition, which I don't think ultimately will happen.
Got it. As it relates to your private financing comments, at what level of net worth does that start to become a part of the conversation?
Yeah, great question. And I have seen that as part of the discussion for clients who have at least $10 million. And I think a lot of it just depends on the client's circumstances. We're talking right now to advisors or working with advisors and clients who have net worths of 15, 20, $30 million with this strategy. I'd say that's sort of the sweet spot if they're in that $15 to $30 million range. The key is that you never want for a strategy like this to in any way hurt their retirement plan or adversely affect it in any way. And so parting with funds for the purpose of funding needed life insurance is great, but it's got to be something that's comfortable for the client to do and comfortable to part with. The nice part about the strategy too is, though, if they ever had an emergency and needed money, they can always call the note due and take back the cash from the trust. So there is a safety valve, but you'd prefer not to use that if you don't have to.
Okay. We've got a couple questions related to your IRA comments. First one, just wondering if there has been any discussion about ending RMDs now that IRAs have a 10-year spend down rule.
So as far as ending RMDs, no, and recognizing that the government wants its money sooner rather than later. I think that's sort of what it comes down to. If anything, I think we'd see more RMDs or accelerated RMDs over the course of time to make sure that funds are being distributed out and subject to tax sooner.
Okay.
So I don't think so.
Can you clarify what you meant when referring to the trust as a beneficiary of the IRA in the 10-year distribution rule?
Yeah, so when the trust is the beneficiary of an IRA, the trust provisions are going to control what the trustee has the ability to do with the IRA. And a lot of trusts have a provision that says the trustee has the authority to take required minimum distributions from the trust, and that's it. So they only have the authority to take required minimum distributions. Well, the only required minimum distribution under the Secure Act is the full distribution at the end of the 10th year, which would require the entire account balance to be distributed after 10 years. In most circumstances, from an income tax standpoint, it makes more sense to take distributions over time, spread them out over the 10-year period. So you're taking less and spreading out the tax liability. And if a trustee doesn't have the authority to be able to take additional distributions in addition to just what's required, then that's where the adverse income tax liability can come into play at the end of the 10th year.
Okay. The questions just keep coming in, so I'm trying to kind of consolidate them as they come in to make good use of everyone's time here. Can you please address the charitable gifting in the scheme of estate planning and keeping the estate below the estate tax exemption or the taxable exemption?
Yeah, fantastic question. Thank you. Charitable planning is one of the greatest ways to be able to reduce potential estate taxation. That's because you've got a client who has charitable intent, number one. And number two, anything that you leave to charity serves as a deduction against estate taxes. So it's almost as if the assets that are left to charity, if a client gifts, $5 million to charity, it has the same net effect of $5 million that would not be included in the estate for estate tax purposes. That's not how it actually works, but it has that same net effect. So that's a really important point, is reviewing a client's plan to make sure that their charitable planning objectives are provided for. And most of the time it makes sense to use retirement assets, because you're not only getting the estate tax benefits by using those assets, you're also getting income tax benefits from it as well, because the charity doesn't have to pay any tax on the account.
Got it. I've got a lot of questions about working with estate planning attorneys. So the first question is just kind of the state of working with an estate planning attorney. I'm in the Bay Area. It's nearly impossible to get an appointment with an estate planning attorney. Is it that way across the US? And do you have any thoughts on getting clients to the front of the line?
Yeah, so I think, yes, it is that way across the country. And I am talking to attorneys on, if not a daily basis, at least every other day. And they're saying the same thing, that they have just had a barrage of clients coming in the door who want to put planning in place, specifically using some of these strategies, using Grantor Trusts and whatnot. As far as getting to the front of the line, I think it's a question of finding the right attorney, and it may be just searching and finding one who actually has some time available. But that is the greatest challenge right now that I'm hearing about, is the estate planning attorneys are so busy trying to put planning in place before we see any legislation actually enacted.
And actually, you just led into the next question. So finding the right attorney seems to be a struggle. I've got multiple questions on this. Basically all around, not all estate planning attorneys are created equal. Do you have suggestions on how to qualify an attorney for referral?
Yeah, that's a difficult one. So certainly, we can always serve as a resource to the extent that we can. That is, through our estate evaluation process, we have reviewed the work of a lot of attorneys across the country. So if there are questions about a particular attorney, certainly we can always answer those. Beyond that, we do have access to a national network of estate planning attorneys who tend to be, let's say, more boutique style and handle more advanced planning. So at least being able to provide a link to that network, and specifically to those attorneys in any advisor's specific geographic area, is something we could certainly do.
Okay. I'm going to finish with this one. I apologize to anybody that we didn't get to. As it relates to revocable trust, the struggle always seems to be getting clients motivated to fund them. Do you have suggestions on best practices? Do you see attorneys or advisors charging a separate fee to facilitate the funding?
Yeah, and I think it's taking the team approach, and it's the attorney plus the advisor, possibly the CPA as well, to sit down and say, okay, you've got this trust that you paid the attorney to create, but it doesn't really do you any good if the assets also aren't funded to the trust. So I think it's a team approach, making sure that the attorney is also on board with pushing the client. And yes, I do see a lot of attorneys who will charge an additional fee and fund the trust for the client. And to me, it's well worth the money. Of course, I'm not spending it, so it's easy for me to say, but at the same time, just to make sure that it's done right, because what happens ultimately, if assets aren't properly funded to the trust, then those assets likely have to go through the probate process upon the client's death. And that undoes a lot of the benefits of the revocable trust, why they created in the first place. So I think, just reviewing the assets and explaining to the client the importance of funding them to the trust, and the difficulty in administering the probate estate to get them into the trust, and how much difficulty that creates for the family and whoever's appointed as the successor trustee under the trust.
Thank you, Brian. Again, apologize to anybody whose question we didn't get to. We're a phone call away, so if you have questions about a specific client scenario, we're always happy to help. Otherwise, Brian, excellent job today. What a great presentation. To anybody that wants to work on a client presentation, reach out to any of your friends at BUI. Thank you all so much for your continued support, and enjoy the rest of your day. Thanks so much.